Before we get started, we just want to thank Old Republic Surety for sponsoring this episode of Let's Get Surety, as well as NASBP virtual seminars for the fifth year in a row. For more information on Old Republic Surety, visit www.orsurety.com. Now on to our show.
You're listening to Let's Get Surety. Let me hear your bonding talk with Kat Shamapande.
Hey everyone, it's Kat Shamapande. Thanks for joining us for this episode of Let's Get Surety. I've got with me today Mark McCallum, CEO of NASBP. Hey Mark, thanks for being on.
Absolutely. Thanks for letting me join, Kat.
And, based off the news we've been hearing, it's the beginning of March about bank closures and such. I think this is an important topic we're going to be talking about today. Mark, what do you think?
Yeah, absolutely. Very timely.
So we're going to be talking a little bit about reinsurance. And to do that, we have Andrew Gray, SVP, Credit, Surety, and Political Risk Underwriter with Munich Re America. Hey, Andrew, thanks for being on.
Hi, thanks for having me.
I'm sure you're busy right now, so I'm glad glad you're able to take some time and talk with us.
Yeah, fairly busy. That's fair to say.
Well, before we dive into the topic of reinsurance, can you just tell us a little bit about yourself and about Munich Re?
Yeah, so Munich Re, when you look at the reinsurance side, we're obviously the world's largest reinsurer and play in all kinds of lines of business. And me and myself, I've always specialized in surety. I have 13 years of experience, almost split 50-50 between the primary side, where as an underwriter, and now the reinsurance side.
That's awesome.
Before we get started, let me clarify that when I or we talk about Munich Re America, that is referring to Munich Reinsurance America, Inc., my employer, and any references to Munich Re are referring to Munich Reinsurance Company, our parent company. Additionally, it should be clear that during this podcast, I'll be sharing my views and opinions, which do not necessarily reflect those of my employer. To that end, my comments are not intended to be, nor should they be construed as, any legal, underwriting, financial, or any other type of advice, professional or otherwise. Rather, this is meant to be conversational and informational only, and listeners should form their own opinion and seek their own counsel and any other professional advice on any of the subject matter we will discuss. Relatedly, neither myself nor my employer assume any liability whatsoever resulting from reliance upon any of my comments. And with that clear, I think we're good to get started.
And how did you find yourself in the reinsurance space?
I think it was right place, right time. I had about 6 years of time on the primary side under my belt, and I think it was just a good opportunity.
Awesome. Well, I feel like before we dive fully into reinsurance, we just have to talk a little bit about what reinsurance is and why it would be important. Because I feel like that might be a good place to start.
Yep, I think most people who would be listening to this podcast should already be aware of reinsurance, but I'll go over it pretty quickly, kind of the what and the why on that basis, just in case there are those that aren't. So in terms of what it is, it's fairly straightforward. It's insurance for insurance companies. The concept is pretty much the same as insurance itself. You have a risk that is, you have risk that is spread out amongst various reinsurers. And it's the losses of the few spread among the many. Same concept as general insurance. So essentially, it's a mechanism for risk transfer. And I hesitate for a second because I'm going to try and measure myself, but obviously I'll use some reinsurance jargon and I'll try and keep it simple and avoid the various colloquialisms. But just for some kind of ground, Lexis, when I say reinsured, I'm going to generally be talking about the surety here, so the primary surety writing company, which is also known as the cedent, which is the one ceding the risk. And likewise, when I talk about reinsurance treaty, I also mean reinsurance program, and I'll probably use those terms interchangeably. When it comes to the why then, and why do sureties choose to buy reinsurance? As I mentioned, it's risk transfer. Generally, what you're seeing though is two things. It's and they're both linked. So firstly, it's the ability to be able to write and retain larger risks, right? You want to be able to write risks that otherwise your balance sheet wouldn't sustain, but are within your risk appetite and within the capabilities of your team to underwrite. That's probably the largest driver. Obviously, at the base of it, you're looking to smooth out results, right? There's a capital adequacy, capital relief element to it. And at the end of the day, if the worst should happen, you want to know that your net results are well protected, and this doesn't become some kind of profit or worse kind of solvency event for your company, obviously.
So, Andrew, do all sureties purchase reinsurance, or do some self-insure their risks?
That is a good question. We see new markets, right, coming to
Okay.
the space, and all these days. I'm going to caveat because I'm an underwriter, I'm not a broker, so people on the broking side will see more than obviously we do. But I have not seen a new market who doesn't want to start writing without reinsurance. In terms of do people not buy, there are markets that used to, and large markets that used to not buy and used to keep it net through some mechanism. I'm assuming a captive of some kind. But we've seen since 2020 more and more of those markets that did not buy come to market. Are there still primary writers who retain their risk 100% net? There might be. None come to mind post 2020 though.
So, Andrew, I know we'll get in a little bit about market conditions, and we talked just in broad terms, the advantages of reinsurance. But why might a company choose not to purchase reinsurance?
Right. So when you're buying reinsurance, you'd expect with a balanced program, you're sharing some of that profitability with your reinsurance partners. Obviously, you're also sharing risk. If you feel you have a very good understanding of the risk profile of your portfolio of surety, and you are comfortable with the returns it is making for you, and you feel you have such a great grasp on that book and the known and unknown risks somehow, then you might say, why would I reinsure this? Because I know what I'm writing. Why would I share this with others? There is no need, essentially. And there were those markets, 2, 3, 4 years ago, 10 years ago. There are increasingly less nowadays. I could speculate as to why. Just the events of this week, there are unforeseen risks that, people far more intelligent than myself perhaps didn't see coming. So some of it is trying to have that protection for unforeseen events, even when you do believe you understand your book. But, a corollary of those who choose not to buy, if they are retaining that risk through their captive, then they would argue if that captive mechanism is adequate, they already have a way to manage that themselves. But it'll depend on a case-by-case basis.
Right. And, I think you were just hitting on my next question in that now it seems that there's greater uncertainty. And certainly Surety has gone through a period of good profitability. And that has in turn meant capital coming into Surety and a lot of competition and new entrants. And then you add on a lot of uncertainty, as you mentioned, the bank situation, economically, war in Europe, and that sort of thing. And I could see why a company would all of a sudden want to be thinking about the proper way that they may want to transfer risk. Is that how you're seeing things develop currently?
Yes, so I think kind of what you're asking about is the market cycle. So obviously we've had 15 years or so of unprecedented profitability on the primary surety side. Speaking solely for the U.S., obviously,
Right.
and you're starting to see. Obviously, there was the pandemic, and then there's the current environment. The buzzword seems to be headwinds, right? Whether it's
Yep.
supply chain issues, labor issues, material sourcing. Risk transfer between owners and contractors, inflation, rising interest rates. All of this is, you're right. It would seem to suggest that there are more risks nowadays that we can, maybe if we can't quantify it, we can identify them. And if we can identify them and not necessarily understand the interplay of all of them, then it might be worth considering reinsurance for quote unquote sleep at night cover.
Right. And, we've been, I guess, touching on surety reinsurance, but reinsurance exists in the larger world. And obviously, P&C carriers also purchase reinsurance. What has that market been like? Is that different from the surety reinsurance market?
Yes, very. So maybe if it's hard to talk about the general market with surety and overall without going back to kind of pandemic times,
Okay.
or I should say
Okay.
the start of the pandemic, and kind of looking at the timeline that way.
Yeah.
Sure.
If I focus on surety for a second, if we go back to end of 2019, 1/1/2020, it was a good results, as you mentioned, a fairly soft reinsurance market. I don't think anyone would argue with that. That kind of persisted until the end of or early April 2020, when the pandemic became apparent in the US. You then had an abrupt hardening of the reinsurance market around the mid-year renewals. And I use the word hardening. Perhaps that's not the right way to describe it. It was more of a pause. I think most
Mm.
reinsurance carriers, at least on the surety side, took a look at the current environment, decided there was maybe, to your point, nascent risks that weren't necessarily well understood. And it's not that they were withdrawing capacity from the market, but they were supporting existing clients, but reluctant to do much else.
Right.
So that caused a kind of a shrinking in capacity for a moment. However, those losses didn't materialize as expected. And there are all kinds of reasons for that. I think the general consensus is, government support by the way of PPP funds, employee retention credits, FM clauses being tested and working at
Right.
least somewhat in line with what was anticipated. But because of that, there was a inflow of new reinsurance capital into the U.S. surety reinsurance market because they saw, okay, this pandemic occurred, loss did not occur. And in the meantime, because there was that kind of abrupt pause in the mid-year of 2020, whether it was reinsureds or their brokers, obviously they were looking for new capacity because that's their role, right? And they were trying to anticipate this pause lasting longer than anticipated. So they were gearing themselves up to need this capacity. Wherever
Right.
those losses didn't occur, this capacity came in and it stayed, right? Because now they had an interest in the U.S. surety reinsurance market. And I say they, I think part of it is reinsurers who are active in the U.S. but potentially not in surety, but were in credit lines and now had taken an interest in surety, or they were foreign, and by that I mean non-U.S.
Right.
Reinsurers, or I should say U.S. reinsurers that are foreign that did not have an established U.S. domicile. And they were looking at now, okay, maybe I can diversify into the surety product. Maybe I've taken losses on trade credit or some other more volatile product during those early years of the pandemic. And that led to this softening returning. So the softness of the market pre-pandemic then started to return late 2020, early 2021. And to get to your question about where the P&C market is, so this ties in to obviously the events of 2020. So we have the headwinds, we have inflation. On the surety side, we start to see primary sureties, reinsureds, asking about, okay, there's inflation, contract prices are at, I won't say historic, but obviously for the recent memory, historic highs. You see contract values
Right.
that are double what they were a year ago. Maybe I should be purchasing more reinsurance, right? For two reasons. One, just to make sure for my own risk adequacy that I have sufficient coverage keeping up with these larger contract values, and two, because I want to continue to support my best accounts. I don't want to lose them to my competition. So I want to be able to extend these larger limits, and to do that, I want to ensure that I have sufficient limit on my reinsurance placement. So we start to see a bit of a hardening, maybe a little bit of firming localized in early 2020, only because you have that supply and demand coming back, where there is now more demand for capacity. Supply's there, but I think reinsurers are being judicious about how they deploy it and on what terms. Then comes the events of the third quarter last year, third, fourth quarter. And by that I mean Hurricane Ian, right? And this is where
Yeah.
in the story, the P&C world and the surety world, kind of bisect. And you have a backdrop on the P&C side of climate change impacts for several
Yep.
years. You have a large amount of hurricane activity. You have, Harvey, Irma, Maria, so-called HIM hurricanes, 2017, all the hurricane activity, in that intervening period to today. You have claims inflation, social inflation, economic inflation, obviously COVID direct impacts, hangover thereof. I mean, we say post-pandemic, but it's really since the pandemic. You have Russia-Ukraine conflict, to your point. So you have all of this background of an increasingly uncertain environment, rising costs, and then you have the impacts of interest rate increases and this uncertainty where you have the appreciation of the U.S. dollar versus some foreign currencies, chiefly
Right.
the euro, and that's going to affect European reinsurers, right? Among them Munich and our competitors in Europe. You have the mark-to-market impact, reducing regulatory capital on those insurers' balance sheets. And then you also have, from those previous catastrophe events, you have less or just lacking availability of retro. And that's, retrocessions where reinsurers cede out reinsurance to reinsurers who sit behind them. And all of that created a perfect storm, no pun intended. And it was Hurricane Ian. I think the loss is still being evaluated, but most can agree it's north of 100 billion US dollars. So that was kind of the straw that broke the camel's back, and it forced reinsurers to rethink certainly some of the cost of capital. And I say rethink, it forced kind of some soul searching on the cost of capital, adequate returns, whether some of these structures on the P&C side were adequate for purpose, whether rates needed to increase, retentions needed to increase. Seeding commissions needed to be rethought. And from what I understand, on a general scale, on the property side, most of that came true. I think most can agree that there was some kind of, let's say, improvement if you're sitting on the reinsurer side, and hardening or restriction of terms if you're sitting on the cedent side at this last January 1st, 2023 renewal. And that started to cause a kind of spillover effect into other lines of business that weren't necessarily P&C. So surety is generally seen as a non-correlating line of business, i.e., when the wind blows on the cat side, to put it mildly, you don't expect that to impact the surety side directly. In fact, one might argue, it's a bit morbid, but one might argue that the surety side benefits with some of those emergency FEMA contracts, reconstruction that has to occur. Right. However, with the effects of Hurricane Ian, it forced all reinsurers for all their lines to rethink their approach. And some of that did lead to, I won't call it a hard market, it certainly is not, but some generalized firming at the last 1/1 renewal for lines outside of the tried and true P&C lines, like surety, like some of the credit lines. It, kind of like a rising tide lifts all ships, that kind of thing. But obviously, surety results, for the most part, I say continue. Let's say continued to be fairly good last year. However, we did start to see, and I say we, I can only speak anecdotally from my experience, and obviously we'll have brokers and other cedents who sit out, see different parts of the U.S. or a different spectrum or operate in a different line of business, and they will have different experiences. But from where I sit, anecdotally, there was a increase in loss frequency and also severity. And when I say severity, there haven't been any industry-wide losses. Cue the events of the last 2 days, and that's kind of TBD. But just looking at last year, you had localized larger losses spread out across the country, but nothing that affected multiple sureties. There was maybe arguably a couple towards the tail end of 2020 or 21. But generally speaking, you're seeing, with rising contract prices, you're also seeing rising relet costs. So before, when you had a loss, you would find a replacement contractor. They would come in, and
Right.
you could try and use available contract funds, offset, and try and avoid having a full bond penalty loss. These days, relet contractors are passing on that risk, right? If they can't have an escalation clause or some kind of guarantee on the costs that they would assume, and they're there to solve the problem. They don't want to assume all of these risks or be it passed off to them. Then they're going to put a premium on their contract price. And that is then going to lead to contract prices that are larger than one would have anticipated in the past. And that we saw a bit of happening last year. So between that and then the effect of Hurricane Ian on the reinsurance space generally, that led to a kind of firming generally at last 1/1. Now we'll have to see how, from what I understand, those PNC dynamics are still at play currently.
Right.
And on the surety side, while knock on wood, I haven't been aware of any material losses on the surety side this side of the year. Obviously, we're seeing this kind of play out now in real time, so we'll have to see how that dynamic continues, or that momentum continues on the surety side into this year.
As you said, I think a lot of folks in surety are curious as to how things are playing out. I think some maybe have anticipated losses earlier. As you said, there does seem to be some consensus building on greater frequency and severity, but at the same point, it hasn't been too dramatic and profitability has remained strong. How do you see factors like the CHIPS Act and the infrastructure bill going into law influencing how you look at reinsurance for the U.S. surety market?
Wow, that's a
Sorry.
very broad,
Sorry to hit you with that one, right?
borderline unfair question. No, I mean, you see that. You see, the kind of Buy America, those announced at the State
Yep.
of the Union, all those kinds of things. It lends itself towards maybe a more protectionist stance for some U.S. contractors.
Okay.
But like any change, it has the potential for disruption and unintended consequences. Obviously, we consider that, and when we speak with our cedents, and obviously we select our risks and we support cedents that we think understand these risks,
Right.
hopefully better than even we do, right? Then it does factor into the equation. But it's at the moment it's nascent, hard to tell. But you would think that with supply chain disruption already forcing contractors to act in a way that might restrict some choice or ability to source key materials quickly, or restrict exports in some kind, and by the same token imports, it's going to change the playing field. If I look to Europe and some of its historic protectionist stances towards key industries and local industries in each country,
Right.
it has the potential for, or I should say, I think the intent is noble insofar as it's meant to somehow level an uneven playing field, but we'll have to wait to see. It's for me too early to say, and I'm probably not the right person to answer that, Frank.
But I mean, that's, very interesting, as you said, so you have the protectionist elements in that, and will that be disruptors? At the same time, eventually we're going to see the money flowing on projects. I've always heard, greater defaults happen when people are eating too much, not necessarily when they don't have as much to eat. So again, how does that factor in from your viewpoint? What kind of questions do you ask the primary carriers in this kind of environment?
Right. So yeah, I was discussing just then, the CHIPS Act and some of the Buy America.
Right.
If we're looking at the infrastructure bill, for sure, the adage is contractors die of a feast, not famine. And certainly now, where we see during the pandemic, we saw concern around, will there be enough work? Long bid lists. You heard of contractors being very competitive in their bids, dropping margins, similar to like what we saw during the last financial crisis. Now, from what we understand, it's the opposite. There is ample amounts of work. contract sizes are larger than they ever have been. It's the care to ensure in this environment that those contractors are being managed by their sureties to their balance sheets, that they're not being overextended on their programs, that those contractors understand their limitations, that they have the sufficient labor, materials, availability of resources, financial wherewithal, credit capacity from their banks, and obviously expertise, which goes without saying, to undertake those jobs. When a lot of work becomes available, I think not just contractors, in any market, there's propensity to stray outside of your bounds because of, to put it nicely, looking to maximize your revenue at the expense of profitability, though. So when we speak with our clients, we're certainly asking them about how they are managing their contractors and ensuring that balance sheets do keep pace. And when they are not keeping pace, or there are signs of unjudicious approaches to business, that they're doing the right thing and saying, look, appreciate your years of relationship. Things have changed. We're no longer the right fit as a surety. Speak to your agent and move to a surety that better fits with where you want to be.
Okay. Wow. So to ask another unfair question. So if you're looking at your crystal ball, right, and 18 months from now, where do you think you're going to be as a reinsurance underwriter?
So looking at the crystal ball, I don't have. If I did, you could.
We all wish we had it, right?
Yeah. we might be doing something else if we did, right? We might be playing the stock market. But no, I would say, and I think my answer is obviously going to be biased. And if you sit with maybe another reinsurer, you sit on the broking side or on the primary side, you might have a different view. I would opine that there's going to be a certain amount of pain in the reinsurance industry over the next 18 months. I think going into 1/1/23, we heard a lot of cautious optimism and some outright pessimism. We probably sit somewhere towards the middle of the scale, but certainly being conservative. But I think there's going to be a continuation of the trend we already saw. I think losses are going to pick up, at least in frequency. Hopefully, severity, we've seen the worst on it, but frankly, I wouldn't bank on that. And as a result, I think reinsurers and primary companies will see some pain over the next 12 months, but hopefully that leads to a needed rebalancing of the equation. The surety cycle has been on the soft side for years and years and years. And then it felt last year there was momentum, like it was starting to turn. Perhaps now recent events, and maybe if there is a continuation of some of this loss and maybe even an increase on the contract side, maybe it's enough to finally cause that cycle to flip. But frankly, I hope I am wrong. I'm being very conservative. I hope I'm wrong for all of our sakes. But if it does occur, it might actually be healthy for the market, as long as no one's affected. No single company or reinsurer is affected disproportionately. One would hope.
Right. So if you're a new entrant into the surety marketplace, you're seeing all this, you're trying to evaluate how best to address their risk and deal with all the complex questions that presents. What is the best path for them in evaluating their decisions on reinsurance? For example, do they need to go and seek out a good reinsurance broker to help them manage that?
Yeah, absolutely. So if it's a first-time buyer, I would certainly direct them to one of our broker partners who would be able to answer all of their questions and also guide them based on their risk appetite and what they're seeking from their reinsurance program, what would work best for them. And then they would be able to go out and pair them with reinsurers that fit their appetite.
That's great.
Right.
It's been so nice having you on, Andrew, and talking a little bit about reinsurance during these crazy times.
Yes, thanks for having me.
Yeah, hopefully we can have you back again sometime.
Oh, absolutely. Maybe we can compare notes in a year's time.
That would be perfect.
Hopefully your predictions are wrong.
Hopefully.
You've been listening to Let's Get Surety. Brought to you by the National Association of Surety Bond Producers. For more information about the NASBP and its members, visit nasbp.org.
Before we go, we just want to say thank you again to Old Republic Surety for their generous support in sponsoring this episode of Let's Get Surety. For more information on Old Republic Surety, visit www.orsurety.com.